Good morning, everybody, and welcome to this month's edition of our IFRS and corporate reporting webinars. Now, this webinar is one of those real big and important ones. As you know, we've scheduled 90 minutes for this one because we're looking at a financial and sustainability reporting update and helping all our attendees to get ready for 31 December 2023 reporting. So it's a big one, and we're hoping it's going to be a goodie. As always, I'm joined by Kevin Frohbus, who's our partner in Sydney. So good morning, Kevin. Lovely to see you.
Good morning, Aletta, and good morning, everybody else. It's good to be here. And can you believe this, Aletta, penultimate webinar of 2023?
It is scary, Kevin. I can't believe it. Over the weekend, my kids counted how many sleeps before we go on a holiday to Queensland, to the lovely warm weather. And I know it was 6 weeks over the weekend, so I cannot believe it. The good news for everybody, we already, Kevin and I and our team are already working on scheduling our IFRS and sustainability webinars for 2024. So when we have our December, our last webinar for the year, we'll also reveal all the webinars we've scheduled for 2024. And I would like to invite all of our attendees, if you've got particular topics that you would like us to present on, could you please drop me an email or drop Kevin an email? You can see our email addresses on the slide. We're working with our team based on what we discuss with clients, but if you've got particular topics, please let us know. It's the right time to let us know now, and obviously we will try and respond. So that's an open invitation to everybody. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And where I am in Melbourne, is the Wurundjeri people of the Kulin Nation. And we also extend that respect to Aboriginal and Torres Strait Islander peoples that are here today. The other big thing for us is on the 31st of October, BDO in Australia has launched our second sustainability report, and that is our 2023 sustainability report. You will remember last year we launched our inaugural sustainability report. In our sustainability report, we are guided by the World Economic Forum, IBC, and we report our initiatives and our issues under 4 pillars. We focus on people, which is very dear to BDO, and our people are the people who work at BDO, but our clients also. We look at planet, and we look at prosperity and principles of governance. And the big new addition in our report this year is we've expanded that section on planet, because this year we've included BDO in Australia's carbon footprint, scope 1, scope 2, and scope 3. And we've included our FY22 carbon footprint as our baseline, as well as FY23. Last year, that initial carbon footprint for FY22, we couldn't get done in time for 31 October reporting. First time we've done it, and it's hard work and a lot of lessons to learn. Therefore, this year we've gone back, we've put in that 2022 baseline, but we've also managed in time, now that we've learned, included our 2023 carbon footprint, so you can see the movement. We're really proud of the way we've reported that on one table with our intensity factors. So we invite you to download the report, look at the report. So this is a separate sustainability report. It's a separate voluntary sustainability report. And in future years, actually 2025, we will have to do mandatory sustainability reporting in our annual report because we're a Group 1 entity. So maybe just bringing it back to what we've talked to before. So please have a look at that report. This report has been my baby, or these reports have been my babies over the last 2 years, and therefore very keen to get feedback. What do you think? The good, the bad, the ugly? Because we want to make sure that this provides the right information to staff, to clients, etc. So today's agenda. we've got a number of agenda topics here. So we are looking at some hot topics in the profession. We give you an update on sustainability reporting. A few things have happened recently, including an ED by the Australian Accounting Standards Board. And we look at an ASIC update. Number 4, very important changes to IAS 1 or AASB 101, classification of liabilities. And then we also provide a lot of updates on changes at a standard setter level, IFRIC agenda decisions, etc. So the first 4 topics, for sure, the ones we'll spend most time on, and according to us, the most important, and then a rundown to keep you up to date on a few other developments. So that's the plan. So Kevin, first of all, I'll hand over to you to look at hot topics in the profession. We start with this because it's important that our clients are aware of all these latest and greatest developments.
Thanks, Aletta. And as Aletta said, we'll do hot topics. Just in terms of how we're going to run this, for those of you who've been to our previous sessions getting ready for the reporting period, it's an hour and a half today or 90 minutes. And the way Aletta and I generally do it is we tend to focus on certain things and maybe perhaps gloss over others, but that doesn't mean they're unimportant. It's kind of a self-study situation. So if we don't get into something that's in the detail, we'll point it out to you, but you need to go and have a look at it. And we'll focus on some of those things that we see often, so they come up a lot. So that makes them important in the sense that they occur a lot, but it certainly doesn't mean that they're more important than everything in the presentation. The slide deck is, as you will see, monstrous in its size, and that's because we want to give you everything you can have at your disposal to go and click on links and find the other information you want to look for if it has an impact on you. And for example, something like hyperinflationary doesn't necessarily apply to everybody, but if it does apply to you, we might gloss over it, but there'll be a link in there and you can go and kind of read up by yourself. So jumping into hot topics then in the profession, some of these come up later on, so I'll run through the list quickly. And really, if you go down the list, some of these are, shall I call it, old favorites. Others are perhaps new, but really they're all been around for some time, especially things like global conflicts and interest rate increases. We're not in a new high interest rate, high inflation environment. This has been around at least for 18 months now, and everything is generally a roll on from that. But I guess it'll set the stage for the rest of the presentation, the first 3 things on that list. Impact of interest rate increases, accounting in terms of uncertainty, and global conflicts have pretty much driven the agenda on everything else, and that includes in sustainability, which Aletta will get into at some point, because at the end of the day, all of those things drive towards how do you make your organization sustainable in the current environment. So interest rates will come up as we go. I mean, I think I wanted to say that we probably left that behind a bit, but oh no, last week, Tuesday, up it went again, another interest rate increase. And I think it's becoming clear to us that measurement is really important, because interest rates impact almost everything in your financial statements in terms of measurement. So we're talking about things like impairment, we're talking about things like fair value measurements, we're talking about fields like sensitivities. You know, when it comes to measuring things like fair value and provisions, they're all driven by discount rates and they're all driven by interest rates. So you really need to calibrate your interest rate increases at your year end or at your reporting period end. We're heading towards a December reporting period. So if you're doing half years or full years for December, you're going to want to calibrate all of your discount rate and your interest rates and your inflation rates as they pertain to measurement. That's probably the key thing. And the key takeaway for those 3 is going to be that everything about measurement is where everyone is focused, including the regulators. So you want to make sure your systems, processes, and controls around measurements of assets and liabilities and calibrations of tests and impairment all take those things into account, including how that flows into cash flow forecasts for going concern, solvency. It's really one big interconnected jungle. Couple of new ones on the list, which will come up with their slides later on, are the term deposits. But the one I would like to kind of just point to again is our leasing, which are the 3 that actually have links attached there. couple of new things on these. I'll start with the second one that's highlighted there. Month-to-month leases are not always short-term leases. Not a new topic, but it's still there. And this is really a completeness exercise. If you have leases that you've entered into a month-to-month or into a holdover, that doesn't mean they're not on your balance sheet. It means you actually do have to do a proper lease assessment on lease term, and very often those things actually end up having lease terms that are longer than 12 months. Even though you might be operating on a month-to-month basis, it really has got to do with who has the right to terminate. And depending on who has the right to terminate in those scenarios, even though you might be operating under a month-to-month scenario, your assessment of lease term under the lease accounting standard may be more than 12 months. And you need to bring that on balance sheet. It's not new. We're not going to spend a lot of time on it, but man, does that come up a lot. And Aletta, I'll look at you on this one. It just keeps coming up about the leases that are not on balance sheet that need to be there, because under the existing framework about who has got the right to terminate, it turns out that even though you might be operating on a month-to-month basis, your lease term ends up being assessed as being longer than 12 months, and you really should be putting those on balance sheet. So just something to kind of bring to your attention. The other one I'll raise is the acquirer in a business combination in terms of lease restoration provisions. This is an interesting one, which I thought the answer was straightforward, but it turns out nobody else did, and so it popped up in the industry, and there was a bit of an argument around this. I'd like to say though that my position was solidified through this particular item. And this really comes down to how do you recognize the lease or the acquiree's lease restoration provision in a business combination? So this is where you recognize your goodwill and consideration minus assets acquired, but more importantly, where the other side of the debit goes to. Because when you are recognizing your lease in normal lease accounting outside of a business combination, your lease restoration provision is recognized as a credit, and it impacts on the other side of that entry, it impacts the right of use asset. So up or down, depending on which way you're going. But when you're doing a business combination, the question was whether that debit went to the right of use asset or whether it actually gets absorbed into goodwill. And that has been resolved in this one. And the reality of it is the standard is very clear about how you recognize the right of use asset in a business combination as being equal to the lease liability. So therefore, the lease restoration provision has an impact on the goodwill at the end of the day. And that wasn't clear to everybody, but it does actually change the answer dramatically if you were doing it some other way. So if you are acquiring leases in a combination, if there's lease restoration provisions in the acquiree, please make sure you understand how to account for the what I call the other side of the entry. Where does it go in terms of that lease restoration provision, and make sure you're getting it consistent with that. Aletta, anything you want to add to that one?
Yes, you knew I would want to add something, so thank you for flagging. I think what was really interesting is we knew that month-to-month leases and holdover leases are still a problem, and I think it's a bit of a legacy problem, because when the standard first were introduced, a lot of people focused on legal lease term. And we know the International Accounting Standards Board actually had to step in and clarify what do they mean with lease term, and that it's not just legal lease term, but you look at the economics around it and commercial reality. So those two, not too much of a surprise, but it's maybe reminders, because as we've just been through 30 June 2023 reporting season, those two continue to be an issue 4 or 5 years later. I think it's hard once people formed a view, even if the standard said to clarify, that information doesn't always flow through the market, right? The first one there that we've got in blue around business combinations is one that came somewhat unexpected. However, in the past 12 to 18 months, we've seen a lot of business combinations. We didn't see a lot of IPOs, but we did see a lot of business combinations. And in a lot of those business combinations, it involved acquiring an entity that already have leases in place. And therefore, there were a lot of questions on how do we determine the fair value of the assets and liabilities acquired. So how do we determine the fair value of those lease liabilities, those right of use assets? What do we do with these restoration provisions? So they're all somewhat linked. And there's the concept of looking at favorable and unfavorable lease terms as well when you acquire another entity and they have existing leases. You don't just take their right of use asset and liability. You think, are those potentially at favorable, unfavorable terms? You have to look carefully about what did you do with these restoration provisions, and you have to reset your IBR very often. So there's a number of things coming to play there. This article obviously focuses on lease restoration provisions. So we had a number of clients recently where we had to do a significant amount of work. First of all, they had to finish out the accounting of the acquiree until the date of the transaction. Then at the date of the transaction, all those leases, which could be hundreds and thousands, had to be revalued. We had to look at provisions. We had to change IBRs and then do the lease accounting going forward. So that's been a big exercise and a big focus. So we just want to flag that. We think we're going to continue to see business combinations going forward in difficult economic environments. So please be careful when you get to your purchase price allocation. And because purchase price allocation around right of use assets, lease liabilities, restoration provisions are not simple. And actually at the moment we're having a lot of discussions with corporate finance when they do purchase price allocation. How does this work? How does it interact? So please reach out if you get that issue.
Aletta, I'll kind of just also jump onto that because I think it's a good point. The reason why this also came up on lease restoration provisions is because perhaps in a low interest rate, low uncertain environment, those weren't really on balance sheet before and maybe weren't material. But it's kind of come as a dawning surprise to everybody that when you acquire a lease restoration provision in a business combination, or really when you have any lease restoration provisions, costs on suppliers to actually restore property have gone up, and also discount rates have changed on them because of things like increases in interest rates and inflation. So suddenly those numbers become really material. So that's another reason why the question was brought to the profession's attention. And it actually does lead me into the next slide, if you'll jump in there, Aletta, because one of the big issues that is on the agenda is obviously, as I said, measurement of assets and liabilities, but the one at the bottom of the list is actually measurement of provisions more generally. So even just outside of lease provisions, it is amazing how many queries and on consulting engagements we've got recently, and Aletta will bear me out on this, that actually have brought us back to how do you measure a provision and what is the discount rate in the provision. And one of the other ones we had was, which I think we raised in a previous webinar not too long ago, was whether you actually using real and nominal cash flows and how that interacts with the discount, because they were either not material or not significant in the past, but now they are. So that is a great example of just how global conflicts and increasing interest rates and increasing inflation has driven a change in measurement of things that maybe wasn't quite the focus attention before, but it has become the focus attention, and provisions are suddenly just appearing out of all directions. Provisions being obligations that need to be settled in the future, and things like restoration and all those types of things. The measurement of those, including inflationary adjustments to the cash flow and how that impacts with the discount rate, is suddenly back on the agenda. And those discount rates are creeping up because, as you know, interest rates are going up. So I think I'll leave it at that for this slide, unless Aletta wants to add anything. The discount rates flowing onto this, Aletta's favorite topic again. Just remember that IBRs are also going up, and it's an interesting contrast to make because different standards have different discount rates. The incremental borrowing rate in the standard on leases is different to the provision discount rate. They're influenced by the same global factors, but they certainly are different discount rates because they represent different different borrowing obligations or obligations to different parties. But the incremental borrowing rate for leases is absolutely going up. If I've got a lease accounting assignment where there's been a new lease or a modified lease, they modified the terms, or they've reassessed the lease term in an option period. Those are the three conditions where absolutely you need to reassess your incremental borrowing rate. And I've seen scenarios recently where one of those three conditions actually happened, but the lease discount rate they were using, the IBR, was like 0.5%. And I was like, that can't possibly be correct because interest rates have gone up quite dramatically. That might have been the IBR, I don't know, 3 years ago or 4 years ago when the standard came out, but it's certainly not the IBR environment we're living in at the moment. And you should be seeing quite a substantial step up on leases if new lease, modified lease, or reassessment of lease term and option periods means you need to reassess your IBR at that moment. And the reason why those three things need a new IBR is because conceptually, if you've entered into a new lease, or you've changed the terms of the lease, or you've changed the period of the lease, you've actually repriced that obligation. And that means you need a new IBR because this is a liability. And so it's all about pricing the obligation. The moment you change the underlying substance of the arrangement by way of renegotiating a lease or entering a new lease or changing the period, they all essentially mean you've repriced the liability, and that's why you need a new IBR. And the IBRs have changed. There's a nice link there to a Corporate Reporting Insights article that you can go and have a look at. And bearing in mind the three factors that go into an IBR are your base rate economic factors, entity-specific financing factors, and lease or asset-specific financing factors. So it's not just using the rate on borrowings. That might be your starting rate to work out your IBR, but you do need to factor in the things that are specific to the lease and the entities and the environment you're in working out your IBR. In terms of accounting, in terms of uncertainty, I mean, where to start with this one? Ongoing wars in the world, and the Ukraine conflict has become a bit of a Middle East conflict, so things are changing there. I think it's becoming more and more obvious to us in the land of financial reporting that more and more entities are being impacted now by wars in the Middle East and overseas. It was maybe a little bit restricted at some point to Ukraine because people organizations were maybe less exposed, but it's creeping through a lot of our client base now where we're seeing this impact. That's energy prices going up, although that's not all driven by wars. That is just also a fact of life of inflation. Supply shortages are emerging in all sorts of different places. So inflation is going up and is certainly not yet in the Reserve Bank's forecast. The point we're making with this is when you come into your going concern, your impairment, your discount rates, you need to factor those things in. And I think what's actually happening is more you can factor those into a reporting period, like you can work out your IBR at a particular point in time, but when it comes to forecasting those uncertainties, so things like going concern and impairment, those are inherently a forecasting type arrangement. The range of uncertainty is widening, and so what we're finding is when we're getting valuations done and impairments done, we're actually finding that the possible answer that drops out of the model is a little bit more uncertain. So there's a bigger range of possibilities. So there's a little bit more work to do in actually pinpointing where in the range you actually land in your impairment assessments and so forth, and your fair value measurements before you actually use that number in your financials. And often that means lots more disclosure around the sensitivities of your models because your range of variables has actually increased. I think I'll leave it at that unless, Aletta, you want to add anything to any of those points.
No, Kevin, I think the key thing here is that we've seen the conflict in Gaza, all of that has another big impact. So similar issues and similar flow-ons, but maybe a lot more of our Australian entities have relationships and have subsidiaries and have dealings with entities in Israel or Palestine or the region in general. We know there's been a lot of startup tech companies in Israel, a very big tech focus, and with links to Australia. So I think where we were talking about Ukraine in the past, maybe a bit removed from Australian entities, but we've seen that the current conflict is closer to Australia and has an impact not only on people and huge humanitarian issues, but also financial statements and businesses.
I would like to say on supply shortages, it's not just tangible goods and inventory. We're especially seeing in the Israeli conflict that supply shortages to actual people and people resources are starting to emerge, and that also does need to filter into things like going concern assessments. The ability to keep going is not all about having money and access to funds, but also actually having access to people and resources. It does need to factor into models if it needs to, and it leads very nicely into the section on sustainability, which Aletta will do, because at the end of the day, sustainability is also a people issue. I think I'll probably gloss over that slide a little bit, other than to highlight severance pays and share-based payments. We are finding some changes to severance pays, also just restructures around ongoing issues, which once again falls into provision standards. So that's a nice segue into provisions is back on the table. But then also share-based payments are absolutely being modified and cancelled. And please be aware with share-based payments is there's a general rule with share-based payments. If you're modifying or amending the terms of arrangements, that you generally don't avoid the expense that you haven't yet recognized under those arrangements. Generally, when you modify a share-based payment, there's a bit of a catch-up that has to happen based on the expense that hasn't yet been recognized under the existing arrangement. A lot of organizations think they get to reverse things when they modify or cancel arrangements, and that's not really the case. So if you are heading down the path of modifying or canceling an existing share-based payment arrangement, just reach out or get some advice on that before you actually amend the terms of the plan, because you may end up with a nasty debit to your profit and loss on the way out, not a reversal. And that is something I see a lot of, and I just want to put that on your agenda. Is don't think because you've cancelled or modified you get to reverse. On the contrary, it often ends up being an acceleration of the unrecognized amount that hasn't yet quite been recognized, and that can impact the bottom line. So yeah, just a word of warning on that.
Yeah, and Kevin, I thought I might add, when we as a team, you're well aware, when we as a team discussed, what are the things that are continuing, the oldies that are still goodies, that are continuing provide issues for our clients, and we have to do a lot of work on, and which are the standards that still provide big shocks. And the one that came up through our team across Australia and New Zealand was IFRS 2, accounting for share-based payments, and in particular modifications and cancellations, because often it's a big surprise to clients on what the actual impact on the P&L is. So I agree with you. That is one to look at carefully.
Yeah, good. All right, Aletta gets to talk about leases a lot, but I get to talk about impairment. It is my favorite topic of all time. Impairment testing, I think the reason why I like impairment testing is because it drops out of the entity strategy and how that translates into forecast cash flows. So I've always liked that because there's a direct link to the organization, its strategy, its risk and opportunities, and I'm using those words specifically because guess what? They're also what we deal with under sustainability. So it's a nice link. But the one that has crept back into our orbit again is actually, once again, how leases and right-of-use assets impact the impairment testing on CGUs. Once again, this is becoming a problem because these numbers are getting bigger and bigger. So leases are not small anymore. They're big, they're significant, and they are an important part of most cash generating units when it comes to impairment. But what's actually the problem is that there's a tendency out in the market to try and adjust the impairment model back to the, shall I call it, the good old days, back before IFRS 16, because no one really understands, or some of the valuers don't understand how the new lease standard and the recognition of right of use asset impacts impairment modeling. So we often find, shall we call it, the incorrect method or the good old days method, that's the one on the right, where organizations tend to back the right of use asset out of the CGU as well as back it out of the accounting. Put another way is they put the model back to the way it used to be when leases were operating leases. That's actually not the correct way to do it. It actually does give a false answer under certain scenarios, especially if you've got limited headroom in your CGU. You can quickly find yourself in trouble because by backing the CGU, the right of use asset out of the CGU, you actually haven't included all assets in the measurement. So you're essentially not measuring all assets for impairment in the CGU, and it often gives you an impairment on your goodwill when there isn't impairment, or vice versa. So I'd encourage you to actually head towards the correct method, and there is an article that we've given you a link to here. It's not new, it's just back on the agenda again. The right of use asset is an important part of the CGU. It should be included, so it grosses up the asset level. But if you're doing that, you need to make sure that you're not double counting it in the cash flows in the model. And what that means is you shouldn't deduct the lease payments in your CGU because they're already in the right of use asset. The asset already exists in the CGU. It's already exists as a financing liability. The liability is there too. So the way you should be dealing with this is making sure your cash flows do not include the lease payments that are already included in the lease liability because it's already in the right of use asset. But that's not all lease payments. There are some lease payments that are still essentially taken into profit and loss as they occur. So things like variable lease payments and short-term and low-value lease payments, they're actually not in your lease liability, so they should be in your cash outflows in your model. And those are sort of some of the tricks you need to. But the other thing is that not all leases extend the full length of the impairment model. The impairment model is essentially an in perpetuity model, whereas the lease is often maybe 2 or 3 or 5 years in length. So you actually have to then cater for that in your lease model by making sure you're accounting for the lease payments that need to be in the model to sustain the business beyond the period of the lease that's currently on balance sheet. There's a bit of trickery going on here. It's a conceptual thing, but it's actually not just one simple adjustment. It's actually a number of sequences of adjustments to cater for things like leases beyond the current lease term, lease payments that are not in the lease liability but part of the lease, and making sure you're not double counting it by including the ROU asset but at the same time including the cash outflow. So sort of double counting. If you're uncertain about this, happy to obviously have this conversation, but we actually have some worked examples. I think it's on the next slide. And I'll just say, so take that on board. And just to complicate the matter, don't forget the impact of the restoration provision in your CGU testing. And guess what? That's there too, and those are becoming material as well. All right. I think, Aletta, I might sort of pick up the pace a little bit because I think there's a lot still to get through. So I'll move on to term deposits incorrectly classified. This is one that's popped up in terms of what the definition of cash and cash equivalents is, and especially in term deposit. It's not a newie, it's an oldie actually, but I think it was just clarified and something we all knew, but sometimes it comes as a bit of a surprise. I'll give you an example about what the issue is, and maybe I'll ask Aletta for you to jump to the next slide because that's actually where the example is. A very quick example. Entity B places excess funds on a 6-month term deposit, let's say on the 31st of August 2023. We're coming up to our December 23 reporting period, which is what the topic of this webinar is today. So the deposit actually matures in 2 months. So at the reporting date, there's 2 months to go. Does that deposit meet the definition of cash and cash equivalents at the reporting date? Now, the definition of cash and cash equivalents generally is about maturity period being less than 3 months, but that maturity period is at the time of originating the deposit, not at the reporting period. So this was a 6-month deposit, which means it actually wasn't a cash and cash equivalent because it was more about investing. So this would not be in your cash and cash equivalents at the reporting period because the nature of the term deposit was not as a short-term deposit. That is the trickery, and I think that is missed by a number of organizations. And so we're just putting that on your agenda, is making sure that the nature of the deposit, and the 3-month is actually assessed at origination when the term deposit is made, not at the reporting period. Just the fact that it's going to mature in the next 2 months does not make it a short-term cash and cash equivalent at the reporting date, because it was actually not a 3-month or less deposit when it was originated. And that's the lesson out of that one. I think then in terms of revenue recognition, where to start on revenue recognition, it's probably my oldie but a goodie. Aletta and I have seen a significant uptick in revenue consultations and advisory jobs in the last few months. And it's actually not new issues. It's issues that were not addressed correctly the first time around when the revenue standard was adopted. But the one that has really come to the fore is principal and agent. Now, the link we've given here is a link to an IFRIC agenda last year that dealt specifically with software resellers. But actually, the principal agent question has actually raised its head just across the board. So not just with software resellers, really every organization that has a third party involved in the delivery of a good or service, you need to do the assessment of whether you're a principal and agent. I think what's become obvious to us is just how many entities didn't even do the assessment to begin with. So I'm not even sure we're dealing with an incorrect assessment here. We're just dealing with assessments that weren't be done before. And organizations and their auditors are starting to become, and regulators are starting to notice that the principal agent assessment may either have not been done correctly in the first instance or wasn't done at all in the first instance. And we are starting to see some reassessments and restatements of this. So I would like you to take this on board. ASIC has started to focus on this too, so it is coming by way of a number of regulatory queries, and we have seen that as well on a practical level. And then I'll leave this. Oh, there's actually a little bit more behind this. The leases versus service concession arrangements. This is one that actually comes up a lot in my client base and on letters as well. And that is when you're involved in delivering a service to a public sector entity, or more important, when you're delivering a service using a public asset and you're actually delivering a service to the public at large. A number of organizations, so we're essentially talking about it on the operator side. There are complications on the government side as well. So if the public sector entity that's granted the concession also has some interesting accounting consequences. But we're really coming at this from the operator side. So you're a private operator delivering a service to government using a government asset. And often that government asset is being used to actually deliver a service to the public at large. Now that can be things like big infrastructure assets, but it doesn't only have to be big infrastructure assets. There are a lot of social and affordable housing contracts set up out there where entities and operators are constructing assets to be used for social and affordable housing, and that housing is being provided on behalf of government to deliver that service to the public at large. The question here is whether you actually have a service concession or whether you have a right to use the asset as an operator under a leasing arrangement. A lot of organizations just go straight to this as a leasing entity, so they account for the asset as a lease, but it's not necessarily a lease. When you are literally delivering a public service to the public at large using a government asset, and in particular whether there's price control and regulation about how that concession runs. And I'll take social housing as a good example. Social housing is quite tightly regulated across the states. You can only use the building or the units for social housing, and the amount you're able to charge the customer is very specifically defined and controlled. That means you're not actually leasing the asset from government. You're actually providing a service on behalf of government using that asset, and the asset does not appear on the operator's balance sheet because the operator doesn't control that asset. Government is controlling the asset, and you're just delivering a service. I didn't realize how prevalent this was, and also how much organizations go straight to leasing without thinking about it. And that's probably because a number of operators are emerging in the market who've never really played in the space before. So a number of new operators, new to the field, and they don't even know that there is an accounting interpretation on service concession arrangements, and the fact that there isn't a lease there, but actually a public service concession arrangement that means the asset isn't recognized on balance sheet. Please take that on board if you're entering into the space under regulated assets that are regulated in terms of pricing and use. That is becoming quite important. Aletta, do you want to add something there?
Yeah, I just wanted to add that people might think that we're making a song and dance here between leases and service concession arrangements just for the sake of a name. It actually has a huge impact on the recognition and measurement of assets and liabilities in the balance sheet, and that's why we're making the song and dance.
Yeah.
And so I think before just going straight to recognizing that right of use asset and lease liability under IFRS 16, let's think if it is a service concession arrangement, then apply IFRIC 12 or interpretation 12 that has various different outcomes, but it's not simple, right? So I think it's important. It could lead to very different asset liability recognition numbers.
And Aletta's right. You often end up with a financial asset or an intangible asset or both, and neither of those are leases or right of use assets. And where it pops out is often in the revenue recognition, because you're not using the asset as a lease. What you're actually doing is delivering a service under the revenue standard, and then the pattern of recognition of your revenue looks very different, because like I say, you're not leasing it out and earning rental income. What you're actually doing is conducting a service under the revenue standard, and you need to recognize revenue either at a point in time or over time, depending on the service you're offering. It's pervasively different. It's not even just one or two line items. The entire set of financials looks completely different, and not only at a point in time, but over the entire life of the concession. So if you get it wrong at the start, the entire accounting right to the end of the concession period, which is often 20, 30, 40 years, will be wrong. So a good point. I'm glad you raised that. Now, in the interest of time, I'm going to jump over the last two very quickly, Aletta, because I have gone on for 45 minutes. So, which is unusual for me to talk so much. It's not in my nature. But the last one is really just classification of share-based payments, which is on the next slide. It's just where it fits in. You can read this yourself, but share-based payments really should be part of your employee benefit expense, and that's also then where that ends up on the face of your profit or loss, depending on whether you're using nature or function. I think I'll leave that to you to take on board as to go and have a look yourself. I'll leave that for later. And I think the last one then, Aletta, is to hand back to you to get us onto another topic, which is sustainability reporting.
Thank you very much. And Kevin, you really are funny today, especially when you say it's not in your nature to talk so much, right? Because you and I know we like to talk, right? We love
and
talking.
I'm actually having fun.
And when we're having fun, and especially if we can talk to each other, it's even more fun. So you are funny today. Sustainability reporting. Sustainability reporting, when we look at sustainability reporting, I think it's important to re-emphasize that sustainability reporting could either mean voluntary sustainability reporting in a separate sustainability report, similar to what BDO Australia has just done on the 31st of October 2023, which we've talked about earlier. And if you do that voluntary report, there's a lot of frameworks that you could use, and I've listed a few there. The important thing for us in Australia, however, at the moment is the right-hand side of the screen, where we look at mandatory reporting, not anywhere, in our annual report. So mandatory reporting in the annual report, and we also know that there will be mandatory assurance over that. So it's a game changer. Mandatory reporting, annual report, assurance, and we are staring down the barrel of a global set of reporting or sustainability reporting standards. So that's the focus, and that's the important bit. That's the bit that's in the annual report and talks to what we do in our audited financial statements too. Now, currently in Australia, we have the Task Force on Climate-Related Disclosures, the TCFD. They've put out some recommendations, And currently ASIC, ASX, all the regulators encourage the use of the TCFD recommendations. Interesting, last week I presented a webinar with Sue Lloyd, who's the Vice Chair of the International Sustainability Standards Board, and the two of us presented a webinar for Chartered Accountants Australia, New Zealand. And in Sue's presentation, she actually flagged that after the ISSB, the International Sustainability Standards Board, published IFRS S2, the climate-related disclosures, the TCFD have now been dismantled and disbanded, the actual organization, because they see that their work has been done and completed. The TCFD recommendations are now embedded in IFRS S2, and the TCFD also now has a seat at the table at the ISSB. So interesting, and I think great endorsement for the work that the ISSB is doing. So if you apply the TCFD recommendations until we get to mandatory reporting under IFRS S2, it's an amazing stepping stone to get ready for IFRS S2. Again, I've previously talked about it, but I think this is actually critical. So I want to re-emphasize that what we're doing here is we are actually linking traditional financial statements prepared in accordance with IFRS and accounting standards, Australian accounting standards. We're linking that with that separate sustainability report, which is the grey block, where you can use GRI standards, SASB standards, whatever standards, right? Whatever framework. And the link we're putting in is the light blue or the aqua box, where we're saying over time, that fantastic information sitting in the separate sustainability report will move to the general purpose financial report. So it's in close proximity with the audited financial statements. So that disclosures in the separate report will move to the annual report. Now it's interesting, often when it moves to this annual report, there will be mandatory standards driving it, like IFRS S1, S2, that will be very prescriptive and will require assurance. When it sits in the grey box, looking at the other frameworks, it's voluntary, no need for assurance. You can use those frameworks to guide you, or you can comply with them. It's a really, you in control of your own destiny. However, once it's an annual report, there's a lot of focus on the annual report, there's investor focus, and therefore we have prescribed standards, we've got assurance. So it's a much harder and a tougher gig. But that's the link. Over time, that grey box will become smaller and smaller, and the actual general purpose financial report will become more comprehensive over time. The IASB and the ISSB are both working on better linkage and better collaboration between the standard setting bodies and the pieces of information. Now, on Monday, the 26th of June this year, the ISSB published their first two standards, IFRS S1 and S2. S1, the general requirements for sustainability information, IFRS S2, climate-related disclosures. Interestingly, IFRS S2 is being mandated initially, and a year later, IFRS S2, the other topics. So there's a clear focus that we're going to on climate change, on carbon accounting, on climate-related disclosures, and then looking at the other topics. Now, a lot of the other topics would already be covered in sustainability reports using separate sustainability reports using these other frameworks. So this happened at a global level on the 26th of June this year. A day later, the Australian government responded by issuing their second consultation paper. The first consultation paper was in December last year, where they said, we are thinking of mandatory sustainability reporting for listed entities. However, after the ISSB finalized the standards, based on consultation over a period of 6 months, Treasury announced on the 27th of June that it's no longer going to have mandatory sustainability reporting just for listed entities, but it will be based on the size of the organization. And they create 3 groups, Group 1, Group 2, and Group 3, and initially mandatory for Group 1, then Group 2, then Group 3. Initially, not talking about public sector, saying Minister of Finance is looking at that, and also for not-for-profits that are lodging with the ACNC, that is for the regulator to decide. However, if you're a not-for-profit lodging with ASIC, you will be caught by the mandatory disclosures if you meet the size thresholds. So the size thresholds we've previously flagged. If you meet 2 of the 3 thresholds, and it's quite big, 500 employees, 1 billion assets, half a billion revenue. Group 1, mandatory reporting, if you're a 31 December year end, will be 31 December next year, 2024, very close. If you're a 30 June year end, 30 June 2025. So this is close. If you're a Group 2 entity, and I've got the thresholds there, you've got an extra 2 years to get ready. And this is to acknowledge the fact that there are staff shortages, resource shortages at various organizations. Also, there's a need to learn and to upskill. Big upskilling exercise going on within finance teams to be able to deal with carbon accounting and mandatory sustainability reporting. Because to be honest, the people who are best placed to deal with carbon accounting, measuring your carbon footprint, scope 1, 2, and 3, as well as doing sustainability reporting, are CFOs and finance teams, because we are familiar with putting in place systems and processes, looking at completeness, getting ready for an audit. So, and a lot of that group of people have to be upskilled. It's not impossible. It's very possible. We're dealing with this just as another group of accounting standards. But there is learning to take place around greenhouse gas protocol and these sustainability standards. And then Group 3 is another year later. And these are all the entities currently lodging audited financial statements with ASIC. Now, this is Treasury's proposed roadmap as of June. We are waiting for the final position. We're expecting the final position shortly, and then obviously we'll communicate that very clearly. I just want to make it very clear that a lot of organizations look at these Group 1, 2, and 3 sizings, and they say, not my problem. It is your problem. It is every organization's problem. In Australia and worldwide, we're seeing this absolutely everywhere. And this is a big issue for smaller businesses. In order to keep customers, smaller businesses have to react. Maybe not react in respect of all the mandatory sustainability reporting, but in the very first instance, to react by measuring their carbon footprint, having it ready, being able to provide it to customers who would need it for their carbon footprint calculations, thinking of setting targets. How can we meet those carbon reduction targets? And the reason for that is, if you look at your carbon footprint, the 3 scopes, scope 3, which is the emissions that come to an entity when they buy goods and services, it's embedded in the goods and services they buy. That scope 3 is between 80 and 90% of the emissions of most entities, including BDO Australia. You could look in our sustainability report. Therefore, if BDO Australia and other Group 1 entities, or any entity who set targets, want to reduce their carbon footprint, they have to reach to their supply chain and say, we need your cooperation to reduce our carbon footprint. Can you please help us? Give us your carbon footprint. Give us your targets. Report on those on a regular basis, so we can incorporate it into our calculations. Potentially, we want assurance over that. Really important how this is flowing through the supply chain. So if you get that call that your customers is looking for that information, please reach out. We can help you. What we're currently doing is a lot of upskilling of businesses in order to think about how do we measure our carbon footprint, what assistance do we need, do we need technology, etc. Please don't think this is the big end of town. This is the whole economy. The other thing that's happened in Australia 2-3 weeks ago, the Australian Accounting Standards Board issued an exposure draft, EDSR1, which is Australian Sustainability Reporting Standards, and they've included in there, I would say, an adaptation of IFRS S1 and IFRS S2, how they see that being rolled out within an Australian context. So globally, we have two standard-setting bodies, International Accounting Standards Board, and we have the sibling International Sustainability Standards Board. In Australia, the activities of both of those are conducted through the Australian Accounting Standards Board. That's why they've issued this ED. So we've got one standard-setting body looking after financial reporting and sustainability reporting in Australia. They've asked for feedback by Friday, the 1st of March, because they need to get the Australian standards out as soon as possible, because if Treasury is demanding mandatory sustainability reporting from 31 December next year, we need the final standards in Australia, to be ready for that. So there's just links to the standards, and we will explore that further. What we've done also is trying to provide some guidance to Group 1, 2, and 3 entities on how they need to get ready and how they could get ready for the reporting. We develop roadmaps around the measurement of your carbon footprint. It's slightly different for Scope 1 and 2 and Scope 3. Climate-related disclosures, how to get ready, how to do your scenario analysis, and then also the IFRS S1, which is a year later. So this is just an example, high level, for Group 1 entities. When we work with you, we break it down to a roadmap on a month-to-month or quarterly level. So please reach out if you need assistance. And we've got similar roadmaps for Group 2 and 3 entities as well, and we can break it down on a monthly basis. As I said earlier, the TCFD recommendations is a powerful stepping stone to get ready for IFRS S2, and we've got a checklist that you can download to assist you to get ready to implement the TCFD recommendations as far as possible, because it is a stepping stone to IFRS S2. I also want to flag that learning exercise around measuring your carbon footprint, which is a mandated required disclosure under IFRS S2, all the measurement is done under the greenhouse gas protocol in the majority, and therefore very important to get your head around what is the greenhouse gas protocol. It doesn't matter which reporting standard or framework you use in your separate report or mandatory report, the greenhouse gas protocol dictates measurement. And then what does this mean for your organization? I think it's important for you, big and small, to understand where you fit into the economic system. Who are your stakeholders? What information will they demand as investors, as customers, etc.? Kevin, I know we talked about it recently. I've got a client where their key investors demand carbon footprint numbers on a quarterly basis. So it's important to know who are your stakeholders and what their requirements are. How can you get ready to meet those? And I think really important, the 5th one, let's get started. This is not a simple exercise, a lot of upskilling required, but please get started. I'll just end there that similar to Kevin and I doing these monthly IFRS webinars, Dylan Byrne and I are also doing monthly sustainability webinars, and our current focus is on the greenhouse gas protocol. Kevin, I'll hand over to you for the ASIC updates.
Thanks, Aletta. And I'll actually just do a little bit of a plug myself. You've mentioned Dylan. I actually did a webinar yesterday with Nick Fox from our CFO advisory team, which can be found on the web on BDO's website. It was expanding the concept of chief financial officer becoming the chief value officer, and the topic we did yesterday was on sustainability and ESG. So it'll tie into what Aletta has mentioned there. And it draws on themes about where the organization fits in the value chain and really all these big issues. And so I encourage you to go and have a look at that if you have a time. Moving on to the ASIC focus areas, while Aletta was talking on the sustainability, I was wondering how I would kind of approach this, because there's a lot going on here. And what I might do before I get into the slides is just sort of put the 3 or 4 things on the table that I think we need to draw out. The regulator is certainly changing their focus, or has been for some time, towards, shall we call them, big business risks or business areas. It's not only about accounting standards anymore, and it hasn't been for some time. So the themes that are drawing out here are things like ASIC focusing on listed entity OFR disclosures about business risk. They're also looking at things like position papers taken by organizations in areas of key judgment and focus, where they are actually starting to move towards a direction of actually treating those position papers as part of the internal financial systems of an organization, as part of the internal control process. In other words, it's as important to have documented accounting and business position papers about disclosures in the financials as it is about actually having a general ledger that has, evidence of transactions. We all think that the trial balance is the end of the process and then you just go off and prepare your financials, but there's a lot of disclosure around it. Things like business risk, things like future strategy, things like impairment model, things like why have you chosen to use the discount rates in provisions. And an organization needs to really document how they got to those areas and actually put them down into position papers, because it's a key part of the financial system. It complements everything else, including trial balances and evidence of transactions. And the regulator is actually starting to talk like that, about expecting to see those documents as a key part of the financial system. So that goes all the way up to the board, and the board making sure that those things are in place as well. It's not just a matter of having Excel spreadsheets with calculations anymore. Key judgments and estimates actually need to be put down into position papers. That comes back to business risk again, business risk and how those disclosures are made. And then also things like solvency and going concern, which is on the slide at the moment. Of all the things that ASIC focus areas for 30 June 23, which will kind of roll forward in, the 2 things on this slide that are probably important to speak about that we haven't spoken about already are solvency and going concern, and then in the far right-hand side, the OFR, so disclosures for listed entities in terms of what investors want to know. Now, I'll start with the OFR again. I remember a time in Aletta, you'll remember this too, when the disclosure was, the disclosure about the OFR was, the directors would make some comment like, the operating results are clearly understood from the attached financials. Remember those days we used to make that sort of statement? And I think those days are beyond us. Even for unlisted entities, that sort of disclosure isn't really appropriate anymore. But the reason why the organization, like the regulator, is focusing on things like business risk disclosure is because they actually can see that sustainability reporting is coming. And if you can't get your disclosures about business risk right, how are you going to get the broader disclosures about sustainability right? Because sustainability reporting and the climate-related financial disclosures that are coming is actually just an expansion on risk, opportunity, strategy, and how that feeds into the numbers. So business risk, which is a current disclosure under the OFR requirements, under the ASIC regulation, is a necessary first step towards getting organizations ready for the broader disclosures that are coming. That is also why it is a big focus area by ASIC, but also investors just need to know this information. If the organization has some very specific business risks that are impacting strategy and impacting the numbers, that's the sort of thing the investors need to know. And that is why ASIC is focusing on that as a particular area. On the solvency and going concern, and we'll come to some of that again because there's some slides later on about it, but on the solvency and going concern assessment, I just want to actually kind of bring this back to Solvency, going concern, and impairment. They're actually three very different assessments. They actually focus on three very different things. Solvency is really about net worth and assets, net liability situations at a point in time. Going concern is about the ability to pay debts as they due for the period 12 months after after issuing the financials. And impairment is really about carrying amount of assets on the balance sheet. But often they start with the same thing, which is the cash flow forecast that drops out of the budget, which drops out of the strategy of an organization. So you really need to get your budget right each year and your cash flow forecast right each year before you can do any of those assessments: solvency, going concern, and impairment. And if you aren't actually doing a proper budget and you're not taking into account trading positions and global conflicts and inflationary environment, the assessments are going to be poor, and they're going to be wrong, and they're going to be inappropriate. So it all links together: business risks, impact strategy, impact cash flow, impact forecasts, impact solvency, going concern, and impairment assessment is all kind of linked. And I'd want to say that the regulator, and this is what the ASIC focus area is, the regulator is focusing on, shall I call it, the beginning to end tail of all of that. How does the organization see itself in the world? How does the risks assess? How does that feed into strategy? How does it feed into budgeting and to cash flow, and then into solvency, going concern, and impairment? Kind of all linked. And so if I had to take one takeaway from the ASIC focus areas for organization is to take the whole holistic risk framework and strategy framework into account. It feeds into everything, including eventually asset values, provisions, and subsequent events, which are the other three items on that list. I'll leave it at that. Aletta, do you have any comment on that?
No, Kevin, I think the only thing is people might think, why are we talking about 30 June focus areas? ASIC has not yet released 31 December focus areas, but we know they don't really change that much in a 6-month period. And maybe just flagging that in the OFR, there's a specific reference in a recent ASIC media release that they're interested in climate risk disclosures and opportunities, as well as a target setting on how to become net zero. So they flag that in their publications as well.
Yeah. Okay. I'm going to be brave and say that the slides at this point are a little bit of a takeaway. And you can read the slides and they'll make sense. There's a bit of ASIC surveillance. There's the OFR disclosure and the position papers. There's some stats about where ASIC focused on their surveillance. If we jump to the next slide, the ASIC enforcer media releases, a lot of the topics on there we've spoken about already. Probably haven't spoken too much about non-IFRS line items, which we'll come to. Impairment features again, and how you use your market capitalization as an indicator of impairment, not the impairment test itself. I think the non-IFRS profit subtotals in the financial statements is an area of concern. It has been for some time. We've put a slide in there, which I think is the next one that you're going to go and have a look at. This is when you put non-IFRS subtotals like EBITDA and all that type of thing. They're not allowed to be more prominent than the IFRS measures. It's not new, but it's back on the agenda because everybody's trying to make the numbers look better and speak to the numbers in a way that makes it seem better. So they come up with exotic, subtotals and normalized earnings and all those sorts of wonderful things. Just remember, there's a media release on that, and also a guide from ASIC to take that on board. And I think moving at a pace, I will say that that's really my ASIC focus area. There we go. There's the RG. You can read through this yourself, because I actually want to give Aletta some airtime on IS1, which is really important. And so I'll hand that back to you, Aletta.
Thank you very much, Kevin. I was thinking the same thing. I'm hoping it's great minds think alike and not fools never differ, because I was thinking it's important that we look at the changes to IAS1, Kevin. Because it's a new change. I think one of the most significant changes, if we look at the actual accounting standards, and then we'll get the rest of the presentation is a bit of a self-study, and people can contact us. Now, changes to IAS1, classification of liabilities, has always been a difficult one. There's always this question whether liabilities should be presented as current liabilities or non-current liabilities. And there's been many issues as we know in Australia as well, where entities got this wrong. So the International Accounting Standards Board embarked on a process to revisit those requirements, and it's been a real journey. So there were two parts of changes. There were changes proposed in 2020, the 2020 changes, and then there were 2022 changes. Now, I just want to flag that the Australian amending standards, so that is AASB 2020-1 and AASB 2022-6, have not yet been incorporated into AASB 101. So if you today pick up AASB 101, it will be the existing requirements, and you will then have to add the overlay of 2020-1 as well as the overlay of AASB 2022-6, because they each follow on each other, and 2022-6 actually amends some of the changes in 2022-1. So it's very difficult to currently read the Australian standards together because you have to overlay three of them. The changes have already been incorporated in IAS 1, so it might be to your benefit to look at the wording in the actual IAS 1 when you consider this. And in order to be helpful, we have created a publication where we include examples on the new requirements, and I'll provide a link to that as well. So just a word of warning around looking at the Australian standards in this space. You are allowed to apply both sets of changes early. You're allowed to adopt it early, but it has to be at the same time because the two sets of changes actually interact quite a lot. If you look at the application dates, the application date is actually the opening balance sheet is 1 January 2023. And what I mean by that is the standard will come into play for 2024. However, there will be a need to do a comparative restatement, so do a restatement of the comparative year. So if you do your financials for 31 December 2023, you will use the existing standard. However, next year, 31 December 2024, you'll apply the new requirements as well as restating 31 December 2023, and therefore your opening balance sheet is actually 1 January 2023. So even the application dates could be somewhat confusing. We want to talk about it now. Although you don't have to mandatorily apply this to 31 December 2023 financial statements, next year you'll have to restate, so you have to be aware of it at least and what the changes will look like. And you could also be renegotiating loans at the moment. Now, we've previously discussed it, and I know in our 30 June session, we discussed the 4 issues that are changing in IAS 1. So first of all, there's the right to defer settlement need not be unconditional, but it must exist at the end of the reporting date. So the right to defer settlement has to exist at reporting date, but no longer does it have to be unconditional. So that's a big change. The second one is also about this right to defer. That right to defer is the most important thing. So we're no longer looking at your intention, what you intend to do, but actually whether you've got the right to refer at reporting date. The third one is liabilities that are settled by transferring the entity's own equity instruments prior to maturity. So for example, convertible notes and bonds. There are no specific rules included on the standard on how to determine the difference between current and non-current liabilities, and specific rules for the first time in dealing with that. You see a lot of convertible notes at the moment. And then there's additional disclosures where the right to defer settlement is subject to the entity complying with covenants within 12 months after the reporting period. So additional disclosures. So there are 4 categories of changes, and I've included a link there to the slides we've used for 30 June 2023, because we've included examples of each of these categories in that presentation. And I'm not going to redo that. However, there's been a lot of debate around these changes, and I want to explore some of the debate. Now, one of the key things is actually that right to defer settlement. And they've included a new paragraph 72 capital B. And this paragraph 72 capital B clarifies how covenants in loan arrangements affect an entity's right to defer settlement for at least 12 months after the reporting period. And there's two things to consider here. You have to comply with the covenant before reporting date. That's the yellow block. You have to comply with the covenant before reporting date. It affects your right to defer settlement at reporting date. So do we comply with the covenant before reporting date? Do we comply with the covenant at reporting date? So we cannot have breaches before or at reporting date. And then the other thing to note, the far right-hand side, if compliance with the covenant is assessed after reporting date, but it's based on the numbers at reporting date. So, for example, we're waiting for the final audited numbers for 31/2023 in order to do the assessment. That still falls within, we have to meet it at reporting date. There's an admin delay in getting the final numbers. Then also, if the covenant says you have to comply with the covenant after the reporting date, so let's say in 6 months' time, that covenant that will be tested in 6 months' time does not affect your right to defer settlement at reporting date. So very important, this is what we mean by it no longer has to be unconditional for 12 months. So we look at covenants that we have to test before reporting date. We look at covenants that we have to test at reporting date, even if there's a bit of an admin delay. However, if there's a covenant that have to be tested within the next 12 months, that would not impact the classification. So that's a new paragraph 72 capital B. Then they've also added, well, not added, but made changes to paragraphs 74 and 75. Now, the numberings are important here because your initial assessment will be, are we caught by paragraph 72 capital B and follow those rules, or are we caught by paragraph 74 and 75 and we follow those rules? That's a very important distinction. In paragraph 74, they talk about when an entity breaches a covenant condition on or before the end of a reporting period, with the effect that the liability becomes payable on demand, that liability would be current. So it's on or before reporting period. Even if the lender agrees after the reporting period, but before we finalize the financials, not to demand payment as a consequence of the breach. And an entity classifies the liability as current because at the reporting end, it does not have a right to defer settlement for at least 12 months after that date. If you look at paragraph 75, however, an entity classifies the liability as non-current if the lender agreed by the end of the reporting period. So before the end of the reporting period or by the end of the reporting period, the lender agreed to provide a period of grace ending at least 12 months after the reporting period. So if we've breached a covenant at reporting, before reporting period or at reporting period, the lender before that reporting period or at that reporting period have given us a period of grace, again, for at least 12 months, then we can continue to keep it as a non-current liability. So a period of grace for at least 12 months after the reporting period. And in that period, the entity can rectify the breach and during which the lender cannot demand immediate payment. All right, so it's a period of grace for 12 months. So these are the key changes around that right to defer settlement. I'm not today talking about convertible notes, and additional disclosures. So we've got a few examples to explore. In the first one, we've got an anticipated covenant violation. So entity A has a bank loan scheduled to be repaid on the 31st of December, year 5. Entity have to comply with a working capital covenant at each calendar year end, 31 December. If entity A fails to meet the covenant, the bank has the right to demand an immediate repayment of the loan. In early December, year 3, in anticipation of a covenant breach in December, year 3, entity A and the bank agree that the covenant test will be waived. So we're not going to test it at all at 31 December, year 3. However, we've inserted a new covenant. Entity A is to test that working capital ratio at 30 June, year 4 instead, so in 6 months' time. And if entity A fails to meet that covenant test at 30 June, year 4, the bank will have the right to demand immediate repayment of the loan. So what would this mean? So first of all, the covenant test has been waived by the bank prior to 31 December, year 3. So it's important that we understand the difference between a waiver and what that means, as opposed to just a period of grace. So this has been completely waived at 31 December. The fact that we're in breach will have no consequence at all. Entity A, therefore, would not be in breach of the loan covenant at 31 December. So paragraph 74 to 75 do not apply, all right, because we're not in breach at all. The covenant test on 30 June is a future test. That new test is a future test, and that test does not affect our right to defer a settlement at 31 December, and therefore this is a non-current liability. So you can see the interplay between, are we within 72B or are we within paragraph 74, 75? If we're in breach, we apply paragraph 74, 75. We're not in breach, we can still look at paragraph 72B. This is a similar example. So this is a violation this time and a period of grace. So we have to repay 31 December. We must comply with the covenants at 30 September each year. Entity A fails to meet the covenant, and the bank has the right to demand immediate repayment based on that test at 30 September. Until that, and the bank has the right to demand immediate repayment of the loan until the next covenant test on 30 December in 1 year's time, unless the bank agrees otherwise. Entity A breaches that loan covenant on 30 September, year 3, so we're in a breach. Now, on 1 October, the bank agrees not to recall the loan for 6 months. So for a 6 months period until 31 March, year 4, we won't recall it. You've got a breach, we won't recall it for 6 months. The new working capital requirements at the end of the 6-month period will come into play 31 March, and the bank retains the right to call the loan at the end of that 6-month period, regardless of whether we're meeting that new test in 31 March or not. So what we've got here, because we've got a breach at 30 September, we apply paragraphs 74 and 75. The bank only provided a period of grace for 6 months, and that is actually 3 months after our reporting date. And therefore, paragraph 75 clearly says, you've got a breach, you've got a period of grace running for 3 months after reporting date. This is a current liability. So paragraph 72 does not apply because paragraphs 74 and 75 will take precedence if we've had a breach. So can you see, do we apply paragraph 72B or do we apply paragraph 74 and 75? And that all depends on whether you've actually had a breach or not. Very important. Then if we look at the next example, we've got a violation of a covenant and we insert a new covenant. So similar, 31 December have to repay in year 5. We must comply with the working capital covenant at 30 September. If entity A fails to meet the covenant, they can immediately demand repayment of the loan. So what happened here? Entity A breaches the loan covenant on 30 September year 3, and 1 day later the bank agrees to legally waive its right to call the loan. So it's a legal waiver. The new working capital requirements that are inserted into the loan will be tested on the 31st of March year 4, so 3 months after reporting date. And if entity A does not meet the covenant at 31 March year 4, the bank will regain the right to demand their immediate payment. So now, what does this mean? Which paragraphs apply? Now here we've got, at the moment, a little bit of debate in practice. The first view is, this is a current liability. We've got a breach of a covenant, and a breach of a covenant triggers paragraphs 74 to 75. And therefore, the borrower may be able to demand repayment within 12 months, and therefore it's a current liability, and that's where BDO is currently sitting, our current thinking. View 2 is that it's a non-current liability because the lender gave up its rights with respect to that 30 September 2023 covenant breach. They said we waive it. It's a waiver. They've actually cured the breach by waiving their rights completely. The borrower is actually in the same position as if that breach has never occurred. There's now a new test being inserted, which is a future test, and therefore people in support of this non-current liability view actually think that the conclusion should be the same as example 1. Now, this is an interesting one. There's a lot of debate about this one. I wanted to include it in the webinar, even though we don't have a final position, because it flags some of the complexities and will keep you informed as this develops. I think what's important here for view 2 to potentially fly, I think one should really carefully understand what the waiver actually means. Right, so if we've waived, have they really waived all rights? So I think it comes a little bit to the legal understanding. What is a period of grace? What is a waiver? What exactly does a waiver entail? But I'll put it out there. Then we have an example on a rollover of a loan, and I know we've reached our time, and so I'll look at this carefully. Entity A's bank loans scheduled to be repaid 30 September year 4. The loan may be rolled over for another 3 years if we meet the covenant. If we don't meet the covenant, immediate repayment. And here paragraph 73 says, if an entity has the right to roll over an obligation for at least 12 months, it classifies the obligation as non-current, even if it would otherwise be due in a shorter period. And so again, here we look at the right to roll over and not necessarily your intention. And so if we have that right and we're happy the right exists, it will be a non-current liability. I've got another example, example 5, which is a 2-step covenant test. So first of all, you need to meet a certain interest coverage ratio. If you don't meet it, you have a period of time to put amount of cash in a bank account to basically cure or remediate your covenant breach. And again, we've looked at, if we've breached the covenant at 31 December and we remediated and the cash remediation hasn't happened by reporting date, what do we do? And there's no right to defer settlement for 12 months because you haven't done the actual remediation by reporting date. So some people would think it's a current liability. There are some alternative views saying it's a non-current liability because depositing the cash is a second stage of the covenant. And it's not really a covenant test. Again, our preference is everything to have happened at reporting date, so a current liability. But this is tricky. We know that the banks are hardening their attitudes, so some discussion and to be careful around these covenants and whether you get waivers and getting it before reporting date. And then I just want to end by saying that currently, if you look at the current requirements, we have a publication with really good examples on the current requirements. And then we have a new publication that's, the previous one is the proposed amendments. So these are examples on these proposed amendments that I've just stepped you through and examples on those. And this one is a link to the current requirements that you still have to comply with at 31 December. So 2 publications, please pick the right one for your situation for 31 December. Kevin, I think at this stage, previously we flagged that there's a lot of information here on standards and update on IFRIC decisions. There's a lot of links in here. If anybody look at the rest of these slides and have particular questions or concerns, please reach out to Kevin and I, and we're very happy to discuss them with you. A lot of this has also been covered in our 30 June webinar. Kevin, as always, such a pleasure to present with you. Thank you for all the fun, and lovely to have your company. And to all our attendees, thank you for coming for this very important update. And next month, it will be the final webinar on IFRS and corporate reporting for 2023. Thank you and goodbye.
Thank you, Aletta. Thank you, everyone. Goodbye.